Hi everyone. Thank you. Thank you, Richard Ditizio. You're Chief Executive Officer of the Milken Institute. Thank you for being with us. We agreed on discussing a challenging topic, essentially the new US administration impact on the economy and markets and investors. Richard, we had a little chat to prepare the session. We brought a lot of different subjects. I think just to get us started, it's fair to say the mood in the market is pretty bullish at the moment. How would you summarize the kind of state of mind of global investors?
Well, thank you. Thank you for having me. I think, as you know, there is an optimism, particularly around the U.S. market, which, if you look over the last several years, has done nothing but ascend. So I think that optimism, there's a notion in economics, reflexivity. If I expect a positive outcome to happen, I then spend and make that so. And I think you're seeing a bit of that. So you've seen over the last 2 years, the S&P in the United States has gone up 58%. Now that followed a 23% decline in 2022, but you do see a lot of the world's capital flocking to the United States. So that success is triggering even more incremental capital flows. The depth of the market, the liquidity of the market, you can actually play U.S. companies and get global exposure. So if you think of a company like Starbucks has over 50% of its stores outside the United States. Many organizations are similar. So banks that make much more of their money outside the U.S. than in the U.S. but are domiciled in the U.S., you have the optionality of investing in U.S. markets but giving yourself global exposure in dollar-based investments. And I think that that's likely to continue, particularly in the notion of deregulation, which is likely to unfold going forward.
This is nice transition to my next question. What are the expectations in terms of actual deregulation? We know that Donald Trump is keen on deregulating. There are expectations around easing of some rules, including on capital requirements, these sort of things. What does kind of global world of investors expect in that regard?
I think, again, there's a lot of optimism about the costs of deregulation going down and then just applying any nominal P/E ratio to some of those publicly traded companies. You would expect an ascendancy and escalation in price. How that really manifests itself in an actual dollar basis is yet to be seen. But the idea that we're going to have less regulation, less cumbersomeness in some of the ability to get things done in the United States is probably necessary. So I think the notion of the new organization, DOGE, that's been founded to really look at how the government is spending, that's not a new concept. You might recall back when Bill Clinton was president, Vice President Gore was responsible for looking at expenses and trying to understand why the government pays so much more than the private sector for many things. So I think the notion of making business easier to do, I think in the financial market, financial companies in particular, you've seen an extraordinary rise in private debt and private equity outside of public markets. Public markets are very regulated. Banks in the United States are very regulated. The capital requirements, if you now have a distribution model, like you do in private debt, so instead of a bank being responsible for lending all of the money, you've now distributed that out into private debt markets. They tend to be unregulated. There's not the same kind of capital requirements. And I think while times are good, that's fine. If you start to have an increase in defaults and troubled assets, the notion of a bank that has a history of how to work out troubled deals, work out departments, the capital requirements which insulate loan losses, then it would be beneficial to have that structure. So I think this notion of trying to level the playing field a bit for the historic financial institutions is one that will be welcomed.
Can that backfire in terms of shareholder protection, though? Like, do you expect any kind of adverse effect, or are there fears of adverse effects to this kind of deregulation drive?
I think the point of regulation is largely one of protectionism. So the short answer would be yes. While the economy is still going forward and doing quite well, the likelihood of there being more troubled assets, industries that fall astray is less. But it's cyclicality. If you just look at markets over the last couple of 100 years, you would know that cycles do unfold in ebbs and flows. I think that the protections sometimes go overboard, and then the expense of those are borne by the shareholders. So if we get to some medium ground, I think that would be helpful.
You were talking earlier about capitals kind of flocking to the US and how it's become a very attractive market. Like, where does that leave other places, essentially? How do you see the kind of tectonic of capital flows shifting in the coming months? Are there other kind of geographies that are more in trouble in that dynamic?
I guess I think of that in a couple of ways. If we think about where capital is being created and unfolding at the fastest pace globally, it tends to be in parts of the world that don't have deep enough capital markets to absorb all of that capital. So part of the flocking to the United States is just because it's the largest market and can digest a lot of these funds. So if you think about places like the Middle East or Southeast Asia, where there's a lot of wealth being created, but if I wanted to invest it all locally, that would prove quite challenging. So I need to kind of move to markets that are digesting that. Now, that being said, given the ascendancy in markets in the US, earnings growth has not kept up. So EPS growth, earnings per share growth, has only gone up about 10%. So relative to how far markets have gone ahead, it's a little bit outpacing. So what I think will happen is that at some point, the US market will become so expensive that other markets just become a screaming opportunity, and then they'll be able to move that money back into some of those emerging markets. The other thing that would concern me on that front is that today, some 54 countries are spending more than 10% of the revenue they take in on interest expense. So if you start to think about where is the funding going to go inside these countries, and the escalation in interest rates over the last few years has really impacted much of the world, the United States included. So as larger and larger percentages of governmental funding goes towards just paying interest expense, there will be less money available to stimulate the economy. So in general terms, a deficit means that I'm spending more as a government than I'm taking in. That's stimulative, right? That should be good for an economy in the short run. But when you keep doing that again and again, and the debt keeps rising, the overall amount of indebtedness in the United States crossed $36 trillion. It's an unbelievable amount of debt, larger than the GDP in 1 year of the United States. So if you start to think of the countries that have more than 100% of their GDP in debt.
I can think of one right here.
So I think that over time, and this goes back to your question, is that I think over time, as those things become less stimulative, then other countries will become more attractive to attract some of this capital, and they will also be maturing their own financial markets and regulation in order to do so.
Which ones do you see as kind of next in rank in that regard, like after the US? Which places do you expect to be more attractive in the coming months if there is this kind of rebalancing movement that you describe, or perhaps sectors outside of the US?
I would look particularly to the Middle East. I think the UAE, Saudi, like they are absolutely interested in creating deep financial markets to absorb a lot of the capital that's created in the region. I mean, historically, all of that money has, some of it's been invested there, but it's flown around the world. I think that as the world thinks about decarbonization, and there's other opportunities that come up from an investment perspective that become attractive, it's not going to happen overnight. And I think that there'll be a weaning off of carbon fuels, and there'll be a replacement industries that create a lot of opportunity.
Where does Europe fit in that kind of landscape? I mean, are kind of European countries' efforts to get more attractive in terms of investment doomed, like in this geopolitical situation? Like, how do you see this from the outside?
I think that sometimes the marketing is important, right? And I think that the notion of, do I feel optimistic about whether or not the people in the area I'm investing in are optimists?
Are they?
Well, I think the notion, like that can-do optimism of the United States that you've just seen now, right? It's attractive. It goes back to what I said. If I really think things are going to get better, there's a University of Michigan that puts out a study about consumer sentiment. It was just recorded at the highest level it's ever been. And the question is very simple. Do you expect that next year your economic fate is going to be better than it is today? And resoundingly, the answer was yes. Now, on the marketing side for Europe, right, there does seem to be a pessimism a little bit that I think makes it harder for global investors to say, yeah, I want to jump into that, despite that the underlying fundamentals are actually okay. The marketing message also goes the other way. So in the United States, before the election, there's an organization called the Harris Poll. They asked citizens about the economy. 50%, despite the stock market hitting a record, unemployment being sub 4% for quite some time, 50% of Americans answered that, yes, we're in a recession. And that just shows the power of the messaging that was being delivered to them through social media and other outlets, that people thought the economy was much worse than it actually is. And that just also says that most people are not paying attention to the financial press, not absorbing all the statistics that come out of the government. It's how do they feel? And when you ask them individually, do you feel that you're better off financially? They said, I kind of do, but my colleagues I know probably don't.
That's really interesting what you say just here, because it's something that we observe a lot in polls, I think, over here too, that when asked about their own kind of financial and economic situation, people usually say that they're actually quite fine, but when they're asked about like the country at large or people around them, they have a much more kind of pessimistic outlook. We were chatting earlier about that too, like what are the kind of reasons to be optimistic? I think perhaps outside of the US in the kind of, again, months and years to come from the economy's point of view?
So when I think about what are the macro trends that maybe we're not paying enough attention to on our investment, there are right now 2.2 billion children in the world. 2 billion of them live in developing countries. So if I was an investor and I was thinking out 50 years, what is the world going to look at? And I think everyone thinks of themselves as long-term investors, but that's really not true because people want to know what they should do tomorrow. And I think that often that ends up making poor decisions for the long term. But if you think about just sheer demography, where are young people? Where are old people with the associated costs of that? There are more diapers sold in Japan for older people than infants. Right? When you think about like, what does that mean? So if I look at the world and I say that the median age in Japan, one of the top 5 economies in the world, is 49, and 29% of the population is over 65. And then I look at a place like Nigeria, where the median age is 18, and less than 3% of the population is over 65. So what is the trajectory on the creation of an economy in that part of the world? What is the trajectory on the expense of caring for elderly populations in parts of the world? And how do you marry those opportunities? Right? So it isn't about what's happening tomorrow or what the next day. It's really about those longer demographic trends that really portend the financial markets and opportunities of the future.
This is obviously generating a lot of political questions here in Europe, including in France, about like the cost of pensions, reforming. Is that something that investors are paying close attention to, like how individual countries or blocks are tackling this issue of an aging population?
I think that if you just think of existing retirement structures all around the world, they were created expecting a very different life expectancy than we've realized. So the average life expectancy around the world in 1900 was 32. And now it's 72. So for most of human history, it didn't move all that much. And then with all of the advances in medical research and technology over the last 120 years, it's moved exponentially. So we were designing these programs closer to the 1900 mark than we are now. In the US, the Social Security system was created in 1933, much closer to 1900 than it is to 2025. So we're stuck with this anachronistic view of when people are going to die. And then also, when a lot of these funds were formed, the actuarial assumptions that were used never materialized. So in many parts of the world, you have this yawning gap between way more people surviving longer than you thought they were going to, and you have to take care of them. And sometimes the return expectations you were hoping for didn't materialize. So unless we start to address that in increases in productivity, maybe you change the retirement age, but I think we're going to have to do something, because this is not just a phenomenon in Europe or the United States, it's unfolding in many places.
Lots of work to do for politicians, sorry, but we cover politics a lot. As we know, though, like the kind of hard decisions or reforming drive are not necessarily popular with voters, and that creates problems for government across the world. It's been a subject for debate also in the US campaign, I believe, like how fundamental of Biden economics were quite good in terms of statistics and figures, but that didn't really do the Democrats any good in terms of the election. Like, how do you kind of see this disconnect between the kind of fundamentals of the economy and what happens in the polls?
So I think that the United States, the largest market in the world, the largest economy, there's an underside to that I don't think people understand in a granular way. 40% of Americans cannot meet an unexpected $400 payment. So we associate so much wealth and all of that, but it's not really true in the middle or the lower middle. And I think this notion of inequality angers people to an extent that they activate at the polls. Only 1% of it's people don't participate in the ascendancy of these markets, right? So I think that while we can say, well, the markets are doing quite well, 1% of the people in the United States own 50% of the market, and the bottom 50% of the United States owns 1%. So if you think about that, 50 Americans control more wealth than the bottom 150 million Americans. Like, that is a statistic that you need to embed. That kind of inequality and how I feel about what my financial future is going to be triggers people at the voting booth. And I think that was potentially what the Democrats missed in their messaging, because it tended to be in an echo chamber of people who were participating in the rise in the stock markets, were very educated, and were not part of those that felt left behind.
Talking about echo chambers and campaigns, I wanted to just take a moment on a bit of a different subject, which is cryptocurrency and the kind of Trump's embrace of bitcoins during the campaign. What does this mean for the kind of traditional banking sector? This kind of increased enthusiasm at the highest level of government for this type of currencies?
So I think of this in a couple of ways. Like, let's think of it from a currency perspective. So the current value of these various currencies is now about $3 trillion. Right? A dozen years ago, it was about $1 billion. So if you think about that enormous increase in purchasing power, there's going to be somebody is going to participate in that profit. And my guess is that the traditional banking system is not going to sit on the sidelines and let everyone else benefit from it. Now, is it traditional money in the case, if it's really a currency, is it money? So when we think about the notion of the incoming administration's embrace of this, there's two factors in that. One is, you may as well try and put some guardrails on it if everyone's going to be participating in it, because right now it feels a little bit like the Wild West. And I think that participating in the construction of how, even if we think of it in embracing it, but having some sort of guide rails around it would be beneficial. And the second thing is, who's buying it? So I think the notion of crypto resonates quite heavily with young men in the United States who actually moved into the Republican camp at the voting booth. So really kind of resonating with that population who wants it. Now, if we're thinking of it as the democratization of access to capital, that's a great thing. And the largest users of fintech tend to be in places like India and Indonesia, Brazil initiated a system called PIX, which is essentially a fintech technology. In very short order, had over 100 million users. And then some ancillary side effects they weren't anticipating. Because nobody carried cash anymore, there was a precipitous drop in petty crime. So there's things about fintech, the mobilization, banking the unbanked. If we really lean into that, the security features of blockchain, period, forget the currency part of it, all very beneficial. But needing, since it's so new, needing to kind of have some sort of rules, and they're going to be needing on a global scale. If you think about the earliest days of crypto, one of the biggest users was the drug trafficking trade because of the anonymity that those assets afford. So we really need to kind of address the downside of all of this simultaneously with some of the upside.
Which kind of entity do you see as best positioned to address this on a global scale?
I think that's yet to be decided. I think that if you think about regulation generally, it tends to be geographically specific, right? I can regulate what happens in my country. The banking system in the United States is regulated by the United States. Except that now in this new world, like flying over here, I was paying bills online. So if regulation really is geographically specific and I'm 41,000 feet in the air, who is governing that transaction? So the notion of geography being the driver towards regulation and this need for my geography to cooperate with your geography is being upended by technology, because technology is making borders porous, if not evaporated, when it comes to things like that. Because I could pull out my phone right now here in France and my US bank account and send money to any of you in the audience. And who's governing that? So I think our notion of what is regulation and who's responsible for it. But we're going to, with things like the drug trade, with things like human trafficking, we're going to need to have some sort of global platform that we all agree to, or we're not going to be able to stop the bad things from happening.
Reminds me a lot of the debate that happened around data regulation and efforts to regulate that at a level that was more than just one country or the usual kind of constituency. I want to just get back, like we'll have to wrap up soon, but get back a moment on the kind of debt situation that we discussed earlier. There are lots of concerns about mounting public debt in the US. Here, like in the US specifically, do you see that as heading towards a crisis moment? We've seen before, like a debt ceiling crisis. Like, is that going to repeat itself?
I mean, one of the interesting things was how little you heard about this from either the Republicans or the Democrats in the lead up to the US election. If you owned a company and had $36 trillion of debt hanging over your head, you might talk about it during the election. But in fact, it wasn't. And both programs that were offered were going to only increase that. Right? So now if you think about the incoming Treasury Secretary in his 3-3-3 plan, right? So he wants to have growth at 3%, 3 million more barrels of oil pumped, each year, and the deficit being no more than 3%, which means I'm going to still have a deficit. I'm going to spend more money than I'm taking, but last year it was 6.8%. He's hoping to get that down to 3. That 3 is going to have to be borrowed as well. I think at some point, if you have enough stimulus and the economy continues to grow and rates start to come down, you can manage the debt effectively. You're not going to get rid of it, but you can start managing it down. If other factors keep interest rates high, right now we're on track in this fiscal year in the United States budget, the debt will be, interest will be about 14% of the budget. As you start getting close to 20% of the budget, right, we're crossing next year $1 trillion in interest expense. When rates were near zero, people didn't pay attention too much. But now that they have risen, that's a lot of money. That's more than the United States spends on defense. So we're going to spend more on interest. And then you start coupling it with all the entitlement programs like Social Security and Medicare. You have like half of the money the United States takes in going on those three things: defense, social benefits, and interest. So I think long term, if the United States doesn't address it, it is going to just, again, what I said in the beginning, it just leaves less money for the government to be a participant in a stimulative way towards the U.S. economy. And so luckily, with all the flows coming in from outside the US, you still have this other channel to further that. But as other markets become more attractive, you might see that change.
Very interesting. Are there any concerns, from your point of view, on that dynamic in Europe? I think here in France specifically, which has like a hard debt situation of its own, there was lots of kind of turmoil over the summer, and then markets' reaction was actually not as strong as expected when the government was toppled and there was a lot of uncertainty. Does that mean that markets are seeing the situation like the fundamentals are better than we think, or like what's the kind of outlook on that?
I think if I use the US as a proxy, and for those of you that are a little bit nervous about the incoming administration, I would say that when Trump 1 started in January 2017, the Dow Jones, just to use a number, was at 20,000. Then we had the Donald Trump presidency, a global pandemic, which shut down economies around the world, and millions of people died. Then we had enormous supply chain disruptions, high levels of inflation, not one but two wars break out. And despite all of that, in May of this year, the Dow Jones was $40,000. So if you think about what is the resiliency of markets to endure changes in administration, changes in economics status, it's pretty strong. And in general, over time, I think it tends to go up and to the right. Since World War II, 86% of months have yielded a positive return in the markets. So I think that we just need to have innovation continue to come out of the business community to help these governments create economic opportunity and good fortune in the future. And that is part of the anti-regulation view to kind of stop restricting innovation.
Thank you. I think we're running out of time. Thank you very much for this conversation. Thank you, everyone.
Thank you very much.
Speaker.